Well, U.S. consumer prices rose by less than forecast in April for a third consecutive month, indicating limited inflationary pressures in the U.S. economy. But what looms ahead, particularly with respect to the risks of tariffs and inflation, as U.S. companies perhaps pass on costs to consumers? Let's talk about that and other things with Ed Devlin. He's the founder of Devlin Capital. He's also former head of Canadian portfolio manager at PIMCO. And as you can see, he's in studio right now. Good morning. Thanks for coming in.
Hey, thanks for having me, Paul.
What's your take on inflation in the U.S. as it comes in softer than expected for a third consecutive month?
Yeah, I mean, it was just a snick, so it wasn't, anything to write home about per se. But the trend is pretty decent there. And as you were saying earlier, the real issue right now around these tariffs is, the sentiment data is terrible. People are not feeling very good about life, neither businesses or consumers in the U.S. and here in Canada too. But there's a lot of distortions. I've seen this movie over my many decades in many countries. Whenever a tax increase is announced, like a VAT or anything, everyone starts front-loading their purchases and their inventories.
Right.
So think of this as a variable, floating, uncertain tax increase. And so you're going to start to see inventories be distorted, consumption patterns be distorted. It's going to take a little while to be able to look through this data and actually get the clear view of the trend.
Does the most recent news on the U.S. and China affect that picture at all? I mean, there are still very meaningful tariffs in place, but they've come down from what were really trade-preventing levels. Yeah,
I'm starting to come around to the view that I think we've now seen the playbook for the movie. Now, the volatility that is Donald Trump, I'm never going to pretend to know, but that it's going to be very loud and project these big tariffs, watch the markets and everything kind of correct around you, and then engage. And then, ask yourself one question. 4 years from now, does Donald Trump want to be talking about tariffs, yes or no? I think the answer is yes. So, is there always going to be somebody somewhere he's got a beef with and he's going to do something with? Yes. Does it look like he's going to have an apocalyptic, year, global ending trade, tariff war? No. So it's somewhere it's not here and it's not there, it's somewhere in the middle. So we're going to have to learn to live with this volatility around tariff announcements. Is Canada going to have a target on its back? Is it going to be Mexico? Is it going to be China? Is it going to be Europe? Who knows who it's going to be? But it's going to be around for a long time, and it's not good for economics. It's not good for business.
Okay, so the Fed and the path of the Fed is crucial to investors all over the world in a number of different ways. Where do you see the Fed going as inflationary pressures recede?
I think Powell was pretty clear that he's going to wait and see. I mean, if you just looked at the inflation data and you saw Fed funds at 4.5, Fed funds are clearly restrictive. Inflation is coming down. You think they'd be cutting in a quote-unquote normal environment.
Right.
But we've had two really big things happen. One is we had a massive inflation spike, and the Fed does not want to repeat that, right? And second is we have these tariffs with very unknown effects. They're stagflationary, broadly speaking, but how much does, tariff-induced inflation get built into expectations in the market, both of the consumers and businesses? That's unknown. So when in doubt, my rule of thumb is the Fed should pause. Is it cut or pause? They should pause. Reverse that for Canada. When in doubt, the Bank of Canada should cut, not pause, because it affects us definitely a lot more. But those are my kind of generic rules of thumb, both from an investment perspective, but also from a policy perspective.
Okay, so where do you see the U.S. dollar going midterm, and by extension, where do you see the Canadian dollar going?
Now, that is that's a hard one because, again, all the volatility around tariffs. You've seen some big moves. It's been very interesting. You've seen the U.S. dollar. I mean, recently we had a rally, obviously, off the back of the China news. But, it's really been kind of in a bearish trend. So you've had higher interest rates in the U.S. relative to the G7, yet you had a weaker dollar. That usually is the reverse. That tells you there's some capital flight happening. There's foreigners that are invested in treasuries that are leaving. Now, whether that's governments or private sector, we'll find out when the data comes through. But clearly that is a trend. Will that trend continue? I guess it's really path dependent on the tariffs, just how volatile and how quickly that happens. I got to think, broadly speaking, it's bad for the U.S. dollar. If I had to, take an over/under, I'd say I'd take the under. But I think the volatility is going to be tremendous.
Okay, let's finish with the big news in Canada today. Mark Carney due to announce a new cabinet in about 90 minutes from now. There's been lots of leaks, as always, what we're expecting. The leaks have been very consistent. A smaller cabinet using secretaries of state as a sort of a second lesser tier of cabinet. The message he appears to want to send is that this is a smaller, more task-oriented, more business-like group of leaders around the cabinet table. What do you expect?
I agree with that. And, I think that, first of all, we should not expect a big amount of fiscal expansion out of this government. Unfortunately, Justin, used all the money up. And so expect Carney to be more involved in interprovincial trade barriers coming down, infrastructure investments. But these things take time. I mean, trade barriers are good. I think the one thing, having setting a tone that the country is under new economic management and it's competent, might help business sentiment and consumer sentiment. I think that's what they can do, and I expect that's what they will do. In terms of the fiscal side of the House, he said famously in his leadership acceptance, he goes, we cannot redistribute what we do not have. And so I think, we're not going to see a lot of deficit spending, I would think, and /hope. And infrastructure spending always takes time. Hence, I think the Bank of Canada should cut rates more aggressively at the margin.
Ed, thank you, as always, for coming in.
My pleasure. Thanks for having me.
Ed Devlin is founder of Devlin Capital. He's also a senior fellow at the CD Howe Institute.